Ever wondered how the fluctuating values of assets and the changing rates of foreign currencies can impact a company's financial statements? It's a complex yet fascinating part of accounting known as revaluation and translation. So buckle up as we dive into this intricate process. First, consider revaluation. Revaluation comes into play when a company reassesses the value of its assets. This typically happens when there's a significant change in the market value of the asset. The process starts with recognizing the current book value of the asset, which is its original cost minus accumulated depreciation. The next step is to determine the fair market value of the asset. This might involve getting an appraisal or using various market indicators to reevaluate the asset's worth. Once the fair market value is determined, the asset's value in the books is adjusted to reflect this new value. But what happens if the fair market value is higher than the book value? In this case, a revaluation surplus is recognized. This surplus is recorded in equity under the heading of revaluation reserves. It's important to note that this increase in asset value isn't considered income. Instead, it's a reserve that provides a cushion against future losses on the asset. On the other hand, if the fair market value is lower than the book value, a revaluation deficit is recognized. This deficit is accounted for as an expense in the income statement. Now let's shift gears and discuss translation. This process is used when a company has foreign operations and it needs to convert its foreign currency financial statements into its reporting currency. To start the translation process, identify the functional currency, which is the currency of the primary economic environment in which the foreign operation conducts its business. Then the financial statements are translated into the reporting currency using the current exchange rate for assets and liabilities and the average exchange rate for the income statement. All resulting translation adjustments are recorded in equity as a separate component, often referred to as a foreign currency translation adjustment. This adjustment is not recognized in profit or loss until the disposal of the foreign operation. In conclusion, both revaluation and translation are critical processes in accounting that help to present a fair and accurate picture of a company's financial position. Revaluation adjusts the book value of an asset to its fair market value, either resulting in a revaluation surplus or deficit. Meanwhile, translation involves converting foreign currency financial statements into the reporting currency, with any translation adjustments recorded as a separate component in equity. So the next time you glance at a balance sheet or an income statement, remember the intricate processes of revaluation and translation that went into creating those figures. It's a testament to the dynamic nature of accounting, continuously adjusting and translating to keep up with our ever-changing world.